years now, and I have the finest regard for the macro and the micro analysis which Neelkanth Mishra every time presents on the channel. I love reading his notes and especially sometimes his articles when he writes on various media forums. Neelkanth, good morning. Thank you for joining us. Before we get into specifics, what do you make of the design of the budget? Do you think the design of the budget is ambitious and implementation would be difficult?
See, I think the government had almost, nearly just 20 days to actually work on the budget, and in many ways that does show up in how the numbers are stacking up. You can clearly see that, the gross tax numbers going up 18, but the net tax to center going up by 25, because most of the increases are in taxes which don't need to be shared with the state governments. All of these suggest that perhaps the government's intention was, the starting point was that we need to have a 3.4% fiscal deficit target. So as you see, the deficit numbers are unchanged from what was there in the interim budget. There may not have been enough time to get some departments to cut their expenditure target, so the expenditure had to be retained. Because of the significant slippage in the FY19 budget versus revised estimates, you had to bring down your regular tax estimates. And so by and large, I think it was a business, it was a budget which we should not read too much strategic intent in the numbers per se. The strategic intent is there on the capital account opening up, which we can come to, but once you adjust for the surcharges and the increase in the excise duty on petrol, diesel, you're talking about a 16% growth in tax revenues, which in an economy growing at say 11%, if you assume that is a nominal GDP growth, still assumes a fair bit of tax buoyancy. But it is a more reasonable number, a more achievable number than the numbers that we had earlier.
Neelkanth, there were three large challenges, at least in our book, before the budget. First, address the liquidity, fix the slowdown, and make India more competitive at a time when trade war is real, whether it is on the land front or the interest rate front or also on the entire labor front. Do you think the budget has addressed the first two, but it has addressed to fail the third and the most important need of the hour, which is to make India more competitive?
Well, I think the financial conditions remain quite tight. So, M3 growth is what we are now tracking on a regular basis to understand how aggregate credit is moving. Because on all other measures, it's very hard to find an objective measure of how credit, the aggregate credit is moving. So M3 is our number. The last print was 10.1% year on year, which is even lower than what we had 3 months back. So I think conditions remain quite tight. Our take on the liquidity window, where the government has offered to take 10% of the first 10% loss, is that it may not change things meaningfully. The banks have been buying structured pools. They've already bought 1.9 trillion rupees. This should help for some of the pools, but not enough to actually get the NBFCs to start growing again. The capital to PSU banks, we'll have to see how it is allocated between the PSU banks. So in FY19, only 17%, so 1 out of 6 was of the capital infusion was actually used for growth, or rather it went into banks that could grow. The rest was mostly for whole filling. Now it will be up to the finance ministry to allocate this capital to perhaps the growing banks, and even there, I think it's going to be a challenge to get some of these banks to grow at say 14-15%, which may be necessary to offset the decline of the NBFCs. So I don't think even the first one has been fully addressed, but at this stage, there's not that much more that the government can do. I think that what the government has done is it is relying on the interest rates coming down. So the active intervention to get the financial markets up and running is not there, but the fact that the government chose to stick to its fiscal deficit target and also signal that it's willing to open up the capital account further, so more foreign capital can come in through two measures that it took, I think those are measures which mean that you will see much lower interest rates, and maybe with a lag of 6 to 9 months, you should start to see the economy bottoming out. On attracting foreign capital, see, disinvestment is something that the government has signaled repeatedly. If you remember, Niti Aayog gave a long list of disinvestment targets, not just privatization, but also, asset monetization, like, land sales. And today's news headlines are again saying that there is going to be a lot of land sale from the government. The fact is that as the US-China trade war heats up, there's been a kind of a detentive for right now, but I think it is not done yet. And as companies start to seek alternatives, they want, clean land titles, easy to acquire land at a reasonable cost with electricity and logistics and water and all that. There are many PSUs which own that land. Just providing it to them could actually lead to much better asset utilization. So in principle, I think the government is working on it. I think in principle, these are very attractive. The 1.05 trillion rupee disinvestment target is also something which is encouraging. But we need to see, I think, concrete action now. So far, given that the Niti Aayog list was given in 2016 and we have not seen very rapid progress, I think it'll be much more comforting if we start to see some action on at least a few of those names, and then the market will project it forward.
A lot has been focused on in individual sectors, but Neelkanth, let's understand from you the fine print when it comes to the announcement in EVs. Do you think that these announcements are in the long term likely to have implications on growth, on jobs, and for the sector in specific?
See, these are at least announcements which show that the government is now starting to think big. See, so far the objective about, or rather the steps were more like, you spend a few thousand crores on incentivizing EVs and all that. Now that the government is showing intent that we will have mega factories for battery manufacturing, we'll have something for solar panels, we'll have, so this shows that at least now the government is starting to think big. Time will tell as to how successful they are. But the showing of intent is, I think, a very big positive step. As you know, India is short of energy. It's short of dense forms of energy. I think on your show as well, I've spoken about it, that to grow the economy, you need a lot of energy. You need dense forms of energy. We only have thermal coal, solar, and wind, and those can be only used if you convert them to electricity. Compared to the global average of 19% as electricity end use. So if the world consumes 100 units of electricity, of energy, 19 units is consumed as electricity. In India, it's only 13%. If we compare ourselves to some of the best economies, that 13 should actually be 25 to 30%. So there is a long way for us to go to convert our energy demand into electricity. And I think it is very heartening to see that the government is now approaching it in the right way, at the right scale. But yeah, I think as some of these policies are fleshed out, as we see some initial steps, I think there will be scope for further encouragement.
Neelkanth, bond yields have come down to about 6.5%. Banks haven't yet been transmitting that. There is also an expectation that foreign capital will come in via the sovereign route now. So going forward, do you actually see an impact on real interest rates? Do you see them coming down?
Absolutely. So we've been saying for a while that, we are perhaps too early on the trade, but we've been saying for a while that interest rates a year from now could be 2 to 2.5% lower. And that just doesn't happen with the repo rate cut, which I think will keep happening because inflation is continuing to trend below what the MPC's target is. But also that the term premium should come down. The term premium was excessively high, mostly because of, I think, poor signaling and because of some badly announced pronouncements from the government. But as the term premium starts to come down, given that the government has shown commitment to its fiscal deficit, the glide path, it is also I think now cognizant of the fact that too much of extra budgetary borrowing will not help. And thirdly, of course, the sovereign thing I think that deserves some more thought, and I'll come to that. But this should help the 10-year bond yields come down. I think the term premium has corrected a bit. It can come down another 30-40 basis points. Once that happens and the credit spread normalizes, it may not happen very quickly, as we discussed earlier in your show. It could take maybe 9 months, 10 months. I think once that happens, interest rates could be meaningfully lower in the economy. And that glide path, I think that path we are I think firmly on. On the opening up of the capital account, see, there is a lot of debate now that we have never done it, so why should we do it? That's not a good enough argument. See, there is no large economy in the world which has a closed capital account. So at some point we have to start realizing that we are now a $3 trillion economy, and also that capital inflows as a percentage of GDP have fallen back to 2002 levels. That was the number in FY18. So our capital inflows are stagnating at $60-65 billion. If we need to keep doing faster, I think we need more capital. Is the dollar sovereign bond the solution? I think that's another question worth asking. Either way, before we embark on something like this, it is important to consider a comprehensive, or rather at least assess where we are and what are the other means available to open up our capital account, and what will be the risks if you were to do this, and how do we mitigate those risks. So we put in safeguards that if the fiscal deficit in any given year is ahead of a certain proportion, then the government should not be issuing these bonds. So those kind of maybe even pro-cyclical measures should be put in place before we embark on something like this. Calibrating it, should we do 10 billion, should we do 40, should we do 80? I think those numbers need to be calibrated and a path laid out before we embark on something like this. But yes, I think the path to lower interest rates is very much is one we are very much set on.
Always maintain that keep the communication right, get the messaging right, tell markets what you're thinking, don't confuse them with every monetary policy. But I'll move away from macros and talk about specifics here. The fact that the promoter holding norms need to be brought down to 65%, that's a thought. It could take 1 year, 2 years, 3 or 5 years, but that's coming. What do you think this means for MNC companies? Because MNC companies beyond a point would be either forced to delist, or they could be forced to float 100% owned subsidiaries. There is a lot of investment in some of these good MNC companies, and it's frankly have created a lot of wealth. What happens there?
Right. So that's the only. That and the potential complexity in M&As is the only perhaps negative side effect, rather say the complication in this move. The objective of this appears to be to improve India's foreign inclusion factor. So if you look at any of the large benchmark indices on which foreign portfolio investors are benchmarked, India's foreign inclusion factor is only about 38%. So to give you numbers, if the stocks included in the global indices are say $1.3 trillion in aggregate market cap, only 38% of that is calculated or is used as a benchmark. Can we move that up? Can that allow more capital to come in? I think, and all of the other things that have been, I think, mentioned in the press today as well about the capital gains. In fact, there's the more the free float, the more the trading, etc. The market makes markets more liquid. In the process, we have this rather unique setup where we have large and very successful MNCs which have very high free float very low free float, and therefore I think that can be an issue. My sense is that each of those three options that you mentioned will be explored by the boards of these companies, and a decision taken as to whether we sell down from 75 to 65, or we go up from 75 to 100, or we just start moving business to a fully owned subsidiary. But either way, for that, I don't think we should prevent the deepening of our equity markets, increasing of our trading volumes, and the fact that our free float in global indices perhaps needs to be higher than what it is right now.
Let's talk about the IT space in detail. Now, the fact that you have the buybacks being taxed, This is going to come as a bit of a setback. What do you make of this, as well as the fact that the rupee, which was earlier a tailwind, has now become a headwind for the IT space? Traditionally, the IT sector was looked at as the space to go to cushion yourself from the acute market volatility. In light of all of these developments, where does IT stand?
Right. So, one of the metrics, I think it's a very important question, given that a lot of investors have been trying to hide from global volatility as well as the economic slowdown in India. In fact, in the run-up to the elections, this was considered the safest trade. See, one metric that we use is the Z-score, which is how many standard deviations away from average multiple, P multiple the sector is and the stocks are. And IT comes out to be one of the most expensive, after consumption. And so both discretionary and staples are high, but I think so is IT. There are very few names which are still trading at a reasonable multiple compared to their own history, but most others are not. In an environment where the dollar revenue growth assumptions and the fact that, there was, we upgraded, in 2017, late 2017, and since then, I think the dollar revenue growth assumptions have moved up. To be fair, beginning of the year, I thought that they would keep moving up. In the last 4-5 months, we've started to worry about it, that perhaps those dollar revenue growth numbers will not move up, and therefore one needs to be quite a bit more cautious. While the global uncertainty remains, I think growth numbers will continue to look quite unstable, and I don't think the domestic economy is also going to look that good for at least the next 2 quarters, maybe more. The tendency to hide there would still be there, but we have to keep in mind that I think this sector is really expensive. I don't think buyback per se would change that view. I think it changes it's just a closure of an arbitrage. It does raise the cost of capital assumptions, etc. in theory, but from the market dynamic perspective, that the fact that global uncertainty is there, I don't think the rupee will appreciate much more. I think the RBI will just want to build reserves. I would say that it should be a neutralish kind of a position for us. That's what we are at. We're very selectively buying them. But yeah, I think we need to start looking a bit carefully at our stock holdings within the sector.
Okay, fair enough. Neelkanth, you did talk about your outlook on interest rates. Do you feel markets, though, are underappreciating perhaps the fact that rates are likely to go significantly lower? And if that does happen, it's natural to, of course, see PE multiples expanding. Do you perhaps feel that given that kind of impact, valuations won't actually be a concern? We're going to see an expansion on the multiples front, and there's going to be an entirely new scenario created. How would you read into that and sort of position investments according to that kind of scenario going forward?
Right. So the fact that the interest rates are on their way down, I think there is a lot of anchoring bias. Just like the average inflation in India is 7.5% for the last 60 years, and the last 3 years is 3.5%. The last 4 years average is 4%, and it seems that the inflation expectations were the hardest to break down in the MPC itself, or maybe within the RBI. Similarly, I think the bond market, the expectation that I think interest rates can be meaningfully lower from where we are now is something that will take time. It may not happen in a month, it may not happen in 2 months, but I think a year from now we should see. That's market force. Once that happens, you're right. I think a lot of the rate sensitives, and which are among our biggest overweights in the market, those would be some REITs, maybe some utilities which have benchmarked returns. And therefore, at a lower interest rate environment, they stand to benefit. So those are sectors and stocks that we like. I think from a market PE perspective, we need to figure out 2 things. The first is earnings yield, which is 1 by price to earnings, which is earnings by price basically. should that be compared to the 10-year GSEC, which is the risk-free rate in India, or should that be compared to the US Treasury? Given that 40% of our free float is owned by foreigners, that is also an appropriate metric. And so unless you assume that the 10-year US also comes down very sharply, there are some people who mistakenly link the US 10-year and the Indian GSEC, which once, of course, we have a much more open capital account, perhaps that may be appropriate, not right now. And I think that with the decline in the US rates, the price to earnings fear that people had, I think should take a back step. So we have done this benchmarking. The gap between the earnings yield gap between Indian index and the US 10-year is already at 3.6%. At 4%, it starts to reduce, and so that premium reducing means that India market becomes more expensive. So, price to earnings goes up. That is a benchmark which I consider more appropriate at this stage, because most bond holders, most equity holders are not really arbitraging between bond holding and equity holding, in India, that is. Now, what happens to aggregate P's? Should the market be worried about it? I think incrementally this would be less of a concern in a lower environment. On the IT question per se, if there are concerns on the dollar revenue growth starting to decline, I think these multiples would appear to be too high.
We're just trying to bring this point out, Neelkanth, that we always looked at India from that historical P multiple, but we tend to overlook when the P multiples were at these levels, the world interest rates, the regime, everything was different. So I'm just trying to bring this point out that if interest rates remain low, your P multiples will remain high. Neelkanth, but aside from the budget, let's capture the headlines.
Yes.
Diwan Housing, we don't know which way that company is headed. Yes Bank will struggle to raise capital. Promoter balance sheets which are struggling, some are selling, some are going belly up, and some are not even investing. I just fear that given that every day we are only getting bad news from NBFCs and bank, in the morning we got a news from PNB. I hope not, I hope I'm wrong, but I just suspect that there is no round two of selling coming in financials and NBFCs.
See, the biggest beneficiaries at this stage are the banks. So when you're talking about financials, and so the banks that have capital, I think will grow, and banks or most financials actually have this circularity, which is either vicious or virtuous. So some bank which is unable to raise capital and cannot grow its tier 1, which was the case with a lot of the PSUs earlier, will keep going into a vicious cycle. And banks, on the top 8 banks in the Nifty are expected to, the consensus number for net profit this year is 800 billion to 1 trillion rupees. And in a banking system where the tier 1 capital of the whole system is 10.2 trillion, that's a substantial amount of capital on which you can grow next year. So I think banks should be okay. On the NBFC side, see, what is happening is quite fascinating. There seem to be, from what we gather from our talking to bond market folks, there are 3 categories of NBFCs now. One, which everyone wants to lend to, and their cost of borrowing is more or less back to, slightly higher maybe, but more or less back to what they were at in August last year. There is the other extreme, which is NBFCs that no one wants to lend to because they fear that there is a hole on the balance sheet which has not been disclosed. And that list is still the same as it was in say, September, October last year. And then there is this middle rung. This middle rung is a set of NBFCs who people don't really suspect will go belly up, but are not very happy lending to, and therefore they're borrowing at very high rates. Now, this situation, of course, cannot last very long, but the fascinating thing is that the groups are the same. So the safe ones are the safe for the last 9 months. The unsafe ones are unsafe for the last 9 months, and there is not one slippage between, say, the middle group from here to the first one or the second or the last one. This is a situation which I think means that once all the defaults have happened of the NBFC that are bound to fail, then the market bottoms off and starts to recover. Because till the failures have happened, see, there are a lot of bondholders who are, say, pension funds, and their board of trustees or something will get informed when there is a default, not in anticipation. And then they will say, oh my God, why were we buying these bonds? Or as the ratings of bonds become more reasonable, like say, there were too many AAAs earlier, and if those AAAs are downgraded, then they become, then they are not eligible for buying by pension funds. So I think those adjustments need to happen. Maybe they will happen in maybe 6 months. Once that is done, then we have truly bottomed off. But from the equity market perspective, I think these are well-discovered risks. The positive thing is that in the last 3 months, we have not discovered many large new problem areas. We've discovered a few, but a few thousand crores in an economy like ours is a very small amount.
Neelkanth, what's the view when it comes to the consumption space? Because expectations were running high, particularly on consumption-related SOPs from the finance minister. Do you think that to a great extent those hopes have been dashed, whether it was on the rural economy front or any sort of incentives being provided? And in that vein, do you think that by the time we actually see a pickup in the overall consumption space, it's going to be a fair amount of time?
Absolutely. So, see, consumption, when we look at it, and it's worth repeating, I've been saying this for a while, but it's worth repeating that around the pay commission time, see, the government is a very, very large employer in the formal system. So almost 30-35% of formal jobs are government jobs. And in that segment, when the pay commission happens, for example, in the 5th pay commission, the increase in the salary and pensions as percentage of GDP was 2%. In the 6th pay commission, it was 2.5% of GDP. And this is a massive, very potent consumption stimulus. In the 7th pay commission, it was 1% of GDP. And the last big state to do it, Maharashtra, has already done it in 1st of Jan this year. So that has faded. When the GST rates rationalization happened, so initially the government went ahead with item-wise revenue neutrality. But once GST, I think that the teething troubles were over, they started to rationalize the rates. So the number of rates, the items in the 28% bracket are now only 2-3%. When we went into it, it was 12-13%. So that rationalization meant that the prices of many of these products actually came down, or the margins were retained by the companies. That led to, I would say, an artificial boost. So you had a pay commission period, and then you had a GST rate cut period. Now, both of those are over. My fear is that the market is extrapolating this kind of growth into the next several years. The government, I don't think, is willing to drive that path, because if you see the cycle, and I'm amazed at how meaningful the pay commission has been. Every time you have a pay commission, 2 years later you have a big balance of payment problem. The currency weakens, interest rates go up, and for the next several years, you are just trying to adjust the fiscal deficit down and trying to stabilize the economy. What is remarkable this time is that we have gone through the pay commission and our aggregate deficits are the same. And I think what this means is that the way the growth will happen in consumption going forward will be through income generation. For that, the economy now needs to bottom out. And for that to happen, you need to go through a very low interest rate cycle. Investments need to pick up. So if I was allocating money in the stock market, I would be much happier buying the industrials and the utilities and the rate sensitives before I start to buy the consumption names. Given the fact that they are, as we discussed earlier, the Z scores, basically relative to their own history, they are all trading at very high multiples. That's a sector which I would be very selective on. There are good names in those sectors as well. But as a sector, I think they're very expensive.
All right, Neelkanth, appreciate you taking the time out and joining in and, really decoding the budget from a macro standpoint, from the overall job creation, as well as a view on the markets and individual sectors.